Hello, I'm Michael Reinking, Senior Market Strategist at the New York Stock Exchange, and this is Market Storylines. Every week we are here to keep you up to date on key trends and events driving global markets. Now, Happy New Year, and hopefully you enjoyed some time with friends and family over the last couple of weeks. Now, we are recording on the first trading day of 2025, so in a slightly different format, we're going to go over the storylines of 2024 and what to be on the lookout for in the year ahead. So let's get to it. Now, 2024 is officially in the books, and by all accounts, it was a strong year with the S&P 500 up over 20% for the second consecutive year, the first time this has happened since the 1990s. Now, by historic standards, it was a year of reasonably muted volatility. Until the summer, the S&P 500 had its longest streak without a 2% decline since the start of the Great Financial Crisis back in 2007, lasting 356 trading sessions. The VIX hovered in the mid to low teens for much of the year, though there were a couple of bouts of volatility, including the one in August when we kicked off this podcast, as there was an unwind of crowded positioning around the globe, with many pointing to the yen carry trade at the epicenter of that episode. Now, that being said, the S&P 500, the max drawdown in the S&P 500 was about 8.5%, which is slightly less than the median annual decline since the mid-1980s. Now, during the year, the U.S. economy continued to outperform expectations, driven by a mix of resilient consumer spending, AI-related capital investment, and growing fiscal deficits. Now, hiring cooled throughout the year, and the unemployment rate did move up to 4.2%, but still remains low by historic standards. Now, after a scare in Q1, inflation continued to moderate in 2024, though the last mile is proving to be difficult. Now, after holding policy rates steady for a little more than a year, the Federal Reserve began its much-anticipated policy shift by cutting 50 basis points in September, followed by two additional 25 basis point cuts in November and December, bringing the total to 1%. However, at the last meeting, Chair Powell signaled that the pace of cuts going forward would slow as the economy continues to outperform expectations, inflation remains sticky, and given the uncertainty related to the impact of Washington policy with the incoming administration. Now, speaking of the election, there was concern that this would be a volatility-inducing event, but a pre-election pullback never really came to fruition. The decisive victory by President-elect Trump removed that overhang and led to a broad-based rally during November. For the second consecutive year, though, mega-cap tech stocks were the best performing, with the NYSE FANG Plus Index up 50%. But there was broader participation throughout the year with some violent rotational activity. Now, small and mid-cap stocks and cyclical sectors, which were perceived beneficiaries of potential policy changes, led to the upside post-election. However, some of that optimism unwound during the month of December as interest rates rose despite Fed cuts, and a messy stopgap funding bill negotiation reminded investors of the slim margins in Congress, which will make it difficult to push forward the Trump agenda heading into 2025. For the month of December, the S&P mid and small cap indices were both down over 7%, wiping out the post-election gains. Both indices ended the year solidly higher, but did underperform the benchmark S&P 500 by over 10%. Now, the December weakness has tempered some of the post-election euphoria as we begin the new year. There are big questions heading into 2025, with reasons for optimism and caution. The U.S. economy remains resilient, but global growth has been slowing. Central bank policy is diverging around the world, which is adding to the U.S. dollar strength, a potential headwind for corporate earnings. Investors are familiar with President-elect Trump's agenda, but there are questions about how this will be sequenced and what will ultimately become policy. Tariffs and protectionist policies are potentially inflationary and open the door to retaliation. Immigration policy and DOGE could also weigh on growth, while growing fiscal deficits and concerns about bond vigilantes will also make further tax cuts difficult to push through. Now, within equity markets, following 2 years of gains, valuations are stretched. AI will remain a key theme, but will continue to take on new forms as investors look for a payoff from the recent investment. The earnings growth gap between the Mag 7 and the rest of the S&P 500 is expected to narrow. Now this is once again feeding the hope that this will be the year of the great rotation, with previous episodes proving to be fleeting. Broadly, earnings are expected to inflect higher, which should help equities grow into those lofty valuations, but clearing that bar could be challenging. And the sell side is pretty uniformly bullish, a different dynamic than we've seen coming into the last 2 years, but are calling for gains of up high single digits, which is in line with historical averages. However, when you look back historically, since 1950, there have only been 6 years where the S&P 500 ended the year up between 5 and 10%. I'd expect some more volatility in 2025, with investors reacting to Washington policy, geopolitical uncertainty, potential growth and inflation scares, and lingering questions around AI. And these are just some of the questions we are here to help you navigate in the year ahead. With that, on behalf of the NYSE, I'd like to wish you a happy new year. And once again, thank you for spending some time with us today. Remember, you can watch Market Storylines on NYSE, tv.nysc.com or our YouTube channel, or you can listen every Friday on the Inside the Ice House podcast feed. Thanks for joining me. I'm Michael Reinking. I'll talk to you again soon.